So I read this piece you wrote that's essentially laying out the case for why we could sort of look to Canada's employment situation and the inflation situation there and learn a lot. And I'll be honest with you, I didn't quite understand it.
Okay.
So kind of give me the sort of the quick layover of what you're trying to make.
So there's this idea, especially in the US, that once you get to a certain level of unemployment, we're supposed to get that sort of Phillips curve moment when price pressures, whether it's in consumer price inflation or wage growth, is supposed to accelerate. And in the US, we've seen some mild wage acceleration, but we really haven't seen much evidence of price acceleration. And one of the counter arguments is we're not measuring the unemployment rate correctly. There are better measures of the unemployment rate, things like the prime age employment rate. While that's a better measure, I agree with that. If you look to the north in Canada, Canada's at a historic low on the unemployment rate. It's at a historic high on the prime age employment rate. It's been at that historic high since about the middle of 2017. Nevertheless, you haven't seen acceleration in both prices or wages, really.
So we have the chart here, and in the gold we have Canada, and you can see that the employment to population ratio for prime age workers, all-time high. So in other words, the history of Canada is measured by the most straightforward measure. The labor market has never been this tight.
Agreed.
And yet what you're pointing out is even there, we haven't seen a real kick up in inflation.
Yes, and if this was supposed to be a useful model for understanding inflation dynamics, I would think by now in Canada, we would have seen the kind of acceleration in wages and prices that validate that sort of framing of how labor markets interact with inflation. But in reality, there's not been a sort of hard destination limit on how far the labor market could tighten or labor utilization could simply increase in Canada. So when we look at the US and we say, okay, maybe it's not the unemployment rate here, maybe it's a different measure that needs to get to this point and then we'll get the inflation, I don't think that's a useful way of thinking about inflation dynamics. At least Canada is showing that that's proving to be a weaker case, that there's some magic level where all of a sudden the inflation erupts.
So in comes the prime age employment to population ratio, which we say is a better measure to measure sort of unemployment and where the economy is. And what I liked about your piece is you made the case that it's a better function now than it was in past, particularly because of the rise of female employment, right?
Yes.
So walk me through why that's a better measure.
So the key reason why it's a better measure is that if you actually go through the household survey, which is what we use for the unemployment rate itself, it's not actually very good at identifying who is unemployed and who is not participating in the labor market. And that's a pretty key distinction to make if you're trying to measure the unemployment rate correctly. There are people who respond, I'm unemployed 1 month, and then the next month they say, I'm not participating. And they go back and forth between the two in a very inconsistent manner, especially when asked how long were you unemployed. These inconsistencies suggest that we really shouldn't be levering ourselves too heavily to like that definition and distinction. We would be better off separating it into the employed and the non-employed than trying to fine-tune who's participating, who's not, which is just harder.
Now, one thing in your piece, there is some good news for economists who are trying to find some relationship between the labor market and inflation, and you point this out. And that perhaps the key is to not look at some level like, oh, below 4% or at full employment, but to look at the pace of job gains at any given moment in time. And as you point out, maybe that could offer some signal of when inflationary pressures might build.
Yes, so I don't want to oversell this at this stage because I think the analysis is pretty preliminary, but we do see when the unemployment rate rises, we do see generally inflation tends to follow with some 12 to 18 month lag to the downside. But it actually looks more correlated to growth.
And here we have that chart.
Yes, so if we actually look at the unemployment rate and core services CPI, which captures a lot of the cyclical elements of inflation, not entirely, but it's pretty good. It's in some local periods correlated, but
correlated-ish.
Ish, exactly, right? If I stare closely, I can find something, but it's not actually that correlated overall. If you try to get a slightly more stable relationship, I think the change in utilization or employment growth actually seems to be a better guide. And the upshot of that, if that's right, is we should be thinking a little bit more about speed limits in terms of where labor utilization can go, and not so much about a hard destination limit or some ceiling on how far we can tighten, which could be pretty cool if it was true.